Welcome to The Explainer. Today, we're doing something a little different. We're stripping all the emotion completely out of the market, and we're looking purely at the tape. The market is in rare air right now, so we're conducting a fast-paced, hard-hitting investigation into exactly where the S&P 500 is going to close at the end of 2026. Look, the bulls are out there screaming about a new paradigm, and the bears, well, they're warning of an absolute collapse. But we don't trade on feelings here. We trade on data. By the end of this explainer, you're getting a hard target. Strap in.
Right now, everybody on the trading floor is asking the exact same question. Will the S&P survive 7,500? When you're trading at these kind of dizzying heights, the air gets incredibly thin. Every single headline, every Fed whisper, every tiny earnings miss, it all feels like the catalyst that's going to send the whole board tumbling red, you know? It's a high-stakes mystery. Are we standing on the launch pad of a multi-year secular bull run, or are we just teetering on the edge of a historic cliff? To solve this, we need to pinpoint the exact coordinates of where we stand today.
As of the close on June 30th, 2026, the S&P 500 index sat at exactly 7,499. We are literally knocking right on the door of that massive 7,500 psychological barrier. This is our current reality, and this is the massive peak we're evaluating today. To figure out if this mountain has a summit or just a sheer drop on the other side, we got to tear apart the underlying engine of the market and see what investors are actually paying for a dollar of corporate earnings.
Section 1. Valuations and Earnings Power. Let's take a look at the fundamental pricing.
Zero in on this historical scatter plot for a second. That red diamond resting right on the trend line, that represents our current forward price-to-earnings ratio of 20.4x as of mid-2026. Now, a 20.4 multiple means we're definitely paying a premium. But notice how it maps historically on that orange line. When the market traded at a 20.4x multiple in the past, subsequent one-year returns haven't been negative. In fact, historically, this specific cluster projects a return of roughly 5 to 8%. So, yeah, it's stretched for sure, but fundamentally, it is not a historical death sentence for returns.
Actually, to really put this into context, let's compare today to the mother of all modern bubbles. The crucial point here is mapping the March 2000 tech bubble peak against our current June 2026 peak. Back in March 2000, right before the floor totally fell out, the forward PE was a staggering 25.2x. Today, we're at 20.4x. While all the pundits on TV want to scream that we're repeating the dot-com crash, the math aggressively rejects that idea. We definitely have a premium valuation today, absolutely, but we are nearly 5 full points below the irrational exuberance of the year 2000. We just aren't in pure bubble territory quite yet.
Moving on to Section 2, the AI tech engine, the ultimate driving force of the decade.
This timeline brilliantly illustrates the sheer velocity of that engine. Back in 2023, we saw Gemini 3 Pro. By 2024, Claude Opus was already revolutionizing enterprise workflows. Then in 2025, GPT 5.3 Codex changed the game all over again. And now here in 2026, we have Claude Mythos. We aren't just seeing incremental updates anymore. We're seeing massive, paradigm-shifting platform releases year after year. The lightning speed of this tech innovation is driving forward earnings estimates sky high. It's exactly what gives institutional money the confidence to pay that 20.4x multiple, because the future earnings growth looks absolutely explosive.
But here's the double-edged sword of that entire tech revolution. 38%. The 10 largest companies in the S&P 500 now make up a staggering 38% of the entire index's market cap. Just 10 mega caps are holding up a $24.4 trillion weight. I mean, this is a level of concentration completely unprecedented in modern market history. It basically means big tech is holding the steering wheel for the entire market. As long as the AI engine is running hot, they drag the index up with them. But if they catch a cold, the whole market goes straight to the ICU.
All right, let's shift gears. Section 3, macro cracks and debt. These are the structural headwinds.
Let's be real. The current macro indicators build a formidable case for the bears. Real GDP growth has decelerated to a sluggish 1.8%. Now, the Fed did successfully cool headline inflation down to 2.3%, but it came at a severe cost. Unemployment is creeping right up, hitting 4.2%. And despite that cooling inflation, the 10-year Treasury yield remains stubbornly high at 4.4%. Look, that 4.4% yield is fierce competition for stocks. When institutional capital can lock in a guaranteed 4.4% risk-free, paying a 20.4x multiple for equities looks a whole lot less attractive. The broader economy is undeniably decelerating.
And then there's the absolute elephant in the room, the U.S. federal deficit. Out of the entire budget, net interest payments on our national debt now consume an alarming 14%. Just let that metric sink in for a second. Just servicing the interest on the debt, which is over $1 trillion a year, is eating up 14% of the entire pie. This heavy burden of government debt severely restricts any future fiscal stimulus. If the economy stumbles, the government simply lacks the bazooka it deployed back in 2020 to bail things out. The debt is a massive structural anchor dragging down long-term growth.
Which brings us to Section 4, the sentiment contrarian play. Sometimes you just gotta bet against the herd.
The juxtaposition here is just staggering. The historical average for consumer sentiment sits around 77.3, but right now, in June 2026, we are sitting at a dismal 49.5. Think about how insane that divergence is. The S&P 500 is knocking on all-time highs of 7,500, yet the average consumer and retail investor is absolutely miserable. They're terrified of inflation, worried about their jobs, stressed out about the deficit. The sheer pessimism flooding the market right now is palpable. Everyone is just waiting for the floor to drop.
But here's the contrarian hook, pulled straight from the historical data. When consumer sentiment hits rock bottom, like a reading of 49.5, it actually acts as a tightly coiled spring. We witnessed this exact same thing in 1975, 1980, 2008, and 2022. When sentiment is universally negative, the weak hands have already sold off. The bad news is fully priced in. Historically, these massive sentiment troughs frequently precede huge double-digit market rallies over the subsequent 12 months. The pessimism itself literally becomes the rocket fuel for the next leg up, because any news that is simply less bad than expected triggers massive institutional buying.
Section 5, the end of 2026 prediction. It's time to synthesize the clues.
Let's rapidly summarize the three clashing forces dominating this tape right now. Step 1. We have stretched valuations at 20.4x acting as gravity, compounded by a slowing macroeconomy. Step 2. We have explosive, relentless AI growth acting as the ultimate engine, keeping tech profits booming. And Step 3. We have rock-bottom consumer sentiment acting as a coiled contrarian spring primed to snap upward. So gravity is trying to pull the market down, but the AI engine and that sentiment spring are aggressively pushing it higher.
So let's actually run the math out loud on how this plays out through the back half of the year. If we take that historical 5 to 8% return we'd expect from a 20.4x forward PE, and we compound it with the aggressive, historically proven bounce that follows a post-low sentiment reading, the upward pressure easily overpowers the macroeconomic drag. The market doesn't need the economy to be perfect, it just needs earnings to hold the line, and AI is pretty much ensuring that happens for the top 38% of the index.
Factoring in all of this data, here is the grand reveal. We are projecting roughly an 8% gain from our mid-year 7,499 baseline. That momentum is going to push the index right past a massive new psychological threshold. Our hard target for the S&P 500 by year-end 2026 is approximately 8,100. The bearish fears are ultimately going to be outmatched by mammoth tech earnings and a massive contrarian relief rally.
The tape points to a really powerful finish for 2026, totally defying the macro pessimists out there. But remember, this market is unforgiving, it's heavily concentrated, and it is moving at the sheer speed of artificial intelligence. If those top 10 stocks stumble even a bit, that 8,100 target vanishes instantly. So I gotta leave you with this hard-hitting question as you evaluate your own portfolios today. Are you positioned for the breakout or the breakdown?